this is another way of looking at adjusting entries. There are some companies that instead of when they purchase supplies, doing it the way we think of doing it, say they purchase supplies on August the 1st, we think of them making this entry. And at the end of the period, let's see, $2,000, and then on December the 31st, let's say that there's only $500 worth of supplies left, which means they've used $1,500 worth of supplies. So you would debit supplies. Expense for the amount that was used, and credit supplies. All right, so on December the 31st, we would so all this to say that my balance at this point would be $500. Now, there's another way to do this. Let me get through some of this here. Get rid of this. It's possible when we first purchase supplies for cash, some companies will enter that or record it in the expense account. They'll record supplies expense of $2,000. So on August the 1st, they would debit supplies expense for the whole $2,000 at this point. And then at the end of the period, they'd count the supplies and they say, oh, well, you know, there's $500 worth of supplies in the cabinet. So what they'll do is they'll debit supplies for the amount that's in the closet, and credit supplies expense for that. That leaves us then $500 in the supplies account and $1,500 in the expense account. Which is exactly what we had a minute ago. It's just they just do it differently. So this is called the income statement method of recording a prepaid asset. Let me show that to you on the little adjusting entry grid that we looked at. And this has to do with this question right here. Has cash changed hands? Yes, it's a deferral. How was cash recorded? If it was recorded on the balance sheet, then if we're paying somebody else, what we did was we recorded an asset, a prepaid asset, and when we adjust it, we would debit an expense and credit the asset. If somebody's paying us, we would have credited the unearned revenue account. So the adjustment would be to debit the unearned revenue account and credit revenue. However, if it was recorded on the income statement, like I just showed you, where it was debited to an expense to begin with or credited to a revenue to begin with, the adjustment would be to debit the prepaid asset for the amount that of the inventory, the amount that you counted in the closet, and credit the expense for that amount. If we credited the revenue account when we first received the advanced payment, then we would debit revenue for the amount that had not been earned and credit the unearned revenue account for that amount. So it's just a little bit different. It's not very common, but it is something that you need to know.